Warren Buffett, as you know, is the best investor the world has ever seen. Thousands and thousands of investors worldwide are always on a lookout for that magic bullet, the magic secrets of Buffett that have made him such a wonderful investor over the years. But let me tell you very frankly that Buffett has no magic tricks or magic bullets up his arms. What he follows are simple investing concepts that have earned him billions of dollars of money over the past 44, 45 years since he's been investing on account of his company Berkshire Hathaway. Some of the secrets that some of the simple rules that Warren Buffett follows for finding out his investments. One is that he looks for a good size of a company. He's not really investing in small companies anymore, given the amount of money he has. He's of course looking for companies with proven management skills, and then of course he's looking at companies or stocks which are trading cheap, which are trading for reasonable valuations. One of the other rules, or one of the most important rules, apart from these three that we've discussed, that Buffett follows to find out great investments, is what he calls good return on equity. Return on equity is simply a formula driven metric which is calculated when you divide the net profit of a company by the equity of the company. So let's talk about the ROE formula here. The ROE, also known as return on equity, equals to the net profit of a company in a year, and you get this figure easily available in a company's profit and loss account in their annual report. So the net profit divided by equity. Equity figure is available easily in the balance sheet of a company. Net profit, you all understand, it's a money which is left over with the company after it earns its revenues and pays out all its expenses. And equity is the money that you as an investor have invested in the company. So equity is all shareholders' money which is invested in the company, and the return that a company earns annually on that equity is called ROE. So Buffett is looking for companies which earn good ROEs, which earns good return on shareholders' wealth, shareholders' money, and that's a very important metric that he looks for while he is finding out his good investments. Now, as I said, a higher ROE, a company which earns a higher ROE, is generally considered a better company than the one which earns a lower ROE. But there are several instances where companies artificially inflate their ROEs to show a better picture. Let me explain with an example. Let us see a typical balance sheet of, say, company A. Company A. Let's see a balance sheet. Here is I'm using a very simplified version of a balance sheet. So there are two sides of a balance sheet. One is the assets, as you know, and the other is liabilities. Yeah. So assets are what a company owns, and liabilities is what a company owes. Liabilities made of is generally, for example, the shareholder wealth, the money that you invest in a company is a liability. So the equity will be the liability for a company, and the assets are the assets, the fixed assets, the current assets that the company own, using the money that you've invested in the company. So the money that you invest in the company is called equity, and the assets it purchases to operate its business is called is assets. Now the company runs its operations using the assets, and it generates a profit every year, right? So there's a profit that a company generates using these assets. Now assume that a company A has an equity figure of, say, 100,000 rupees. 100,000 rupees. And its also assets, since it's a balance sheet and both the assets and equity liabilities match, the assets are also 100,000 rupees. So it's used the entire shareholder money to invest in assets, to purchase assets of 100,000 rupees. And the annual profit, assuming in the first year the company earns a profit of, say, 10,000 rupees. So based on the above formula, the ROE for this company A is 10,000 divided by 100,000 of equity, which gives a figure of 10%. So this company earns a 10% ROE on return on equity, right? Uh, Now let's take an example of company B. Just let me change the color. Yeah, the company B, which is of the same size. So let's draw the balance sheet for this company as well. This is the asset side, this is the liability side. Now the assets, as I said, the company is of the same size, so it owns assets of 100,000 rupees, exactly like company A. Now what it does, instead of using entirely, instead of taking money from shareholders entirely, it say borrows 50,000 rupees from a bank. As you know, there are two ways of funding a company's business. One is to borrow from banks or other institutions, and the other is to take money from investors. So it borrows 50,000 rupees from banks, which is known as debt. And so what remains to fund its 100,000 rupees worth of assets is the equity figure, which is remaining 50,000. Yeah. Now assuming that the profits that the company earns, company B earns, is same, which is 10,000 rupees, right? Now here, since the company is employing debt, we also get to calculate a figure called ROCE, which is return on capital employed. Capital is the total amount of money which a company employs, which is debt plus equity. So ROCE, simple formula is 10,000, which is the profit that the company earns. And believe me, and kindly understand that this 10,000 is before paying the interest. Now the debt that the company earns from a bank also the company needs to incur an interest of at the rate of say 8% interest, which is around rupees 58% of 50,000, which is around 4,000 rupees per annum. Yeah, so this is the amount of interest that the company earns. So for calculating ROCE, since we are calculating it on total capital employed, we'll take the total amount of profit which the company has earned before it pays an interest. So the total amount of profit that the company earns before paying interest is 10,000 rupees. Its total capital employed again is debt plus equity, which comes to a figure of 100,000 rupees. So the ROCE is 10%, which is same as the ROE of the of company A. Now since we said that it needs to pay 4,000 rupees of interest per annum, its net profit will be net profit for the company B will not be 10,000. It will be 10,000 minus 4,000 of interest, right, which is 6,000 of net profit. Yeah, 6,000 of net profit. Now to calculate the ROE of this company, we'll divide the ROE of this company, we'll divide the 6,000 figure, which is the net profit after paying the interest, upon the 50,000 of equity, not 100,000, because equity is 50,000. We are calculating ROE here. So which gives a figure of 12%. So you see, the companies, both the company A and company B are of same size, but still company B is able to earn a higher ROE, which is say 12%, as compared to company A, which earns a ROE of 10%. And the only difference between these two companies is that company B has assumed 50,000 rupees of debt, and company A funds entire of its assets with 100,000 worth of equity. So just by taking on debt on its books and having the same size of assets and earning the same amount of profits, company B has been able to show a higher ROE figure of 12%. This might seem good on first instance, but consider the impact that debt can have on a company's long-term financial position. A company has to pay 4,000, for example, company B has to pay 4,000 rupees of interest every year, whatever be its profits, because you can't say to a bank that I have earned less profit, so I'll pay you lesser interest, so I will not pay you interest. It is a fixed payment that the company B has to make every year. So even in case of a slowdown, when the profits are less, profits are not 10,000, for example, the company A profit, company B profits in say the second year due to a slowdown fall to 5,000 rupees. So out of the 5,000 rupees of net profit before interest, it has to pay 4,000 rupees of interest. What remains with it as net profit will only be 1,000 rupees. So that's an impact. That's a negative impact of having debt on your books, because you have to pay a fixed amount of money every year as interest, as compared to equity, where you pay a dividend to shareholders, you don't pay any interest, and that dividend is dependent on the amount of profits you earn. So it's not a fixed figure. You may or not pay dividend in a particular year depending on your financial position during, or financial your profits during that year. So as we saw from this simple explanation, company B with some amount of debt but same size of operations, same amount of profits, showing a higher ROE, which is an artificially higher number compared to company A, which is earning a lower ROE but which has a safer balance sheet. So this is how companies use debt to prop up their ROEs. And while it might look good, a higher ROE figure might look good in the short term, when you take into account the debt, interest on debt that the companies have to pay, and the safety of the balance sheet, the ROEs might fall. They might be volatile for companies like company B. So it's very important that you understand it. And this is what Warren Buffett says. He is looking for companies with good ROEs with little or no debt. So he's not saying good ROEs in isolation. He's saying I'm looking for companies with good return on equities, but those companies should have little or no debt on their books. I hope this explanation has helped you understand the concept of ROE, and how companies which take debt to prop up their ROEs are generally dangerous propositions. Thanks a lot. Thanks for listening.